Good morning, ladies and gentlemen. My name is Alex, Senior Account Executive at GDMFX with today's European Session Outlook. We'll start with the North American markets. We had durable goods orders for September, 1.8% better than expected at negative 1.2%, and durable goods orders ex-transportation, 0.4% better than expected. Consumer confidence for October was 5.3 worse than expected, and the S&P Case-Shiller Home Price Indices year-on-year was as expected. The market services PMI 0.7 worse than expected, and market PMI composite 0.5 less than previous. The dollar rose Tuesday against most of its rivals, but held within a tight trading range as investors braced for the outcome of a two-day Fed meeting that will end today with the central bank's policy statement. Both the Dow and the Nasdaq ended sideways, and the Dixie is up to 96.95 from 96.76. The USD Canadian dollar went up with 11 points. That was the biggest mover. USD Swiss franc 4 points down, and then the USD JPY 5 points down. The reason is because investors bought the perceived safety of the Japanese currency after a US Navy destroyer sailed near artificial islands claimed by China. Today's Tier 1 news is Fed's interest rate decision. Market analysts say there is a small chance for change. Onto the EU markets. The euro, it fell against the dollar after ECB chief economist Peter Praet made dovish remarks, saying there are no taboos for the ECB when it comes to finding ways to try to push up the chronically low level of inflation in the eurozone. No taboo is naturally interpreted as more quantitative easing from December. Hence, it is just a matter of time for the euro to resume its slide toward 1.05, 1.08. Yesterday, we had the EU money supply year-on-year come out 0.1% worse than expected, and private loans come out as expected at 1.1%. The DAX 30 is 65 points down, the CAC 40 is 30 points down, and today in the morning we had the German GfK Consumer Confidence Survey come out as expected at 9.4, and German import price index year-on-year 0.5% worse than expected. We have consumer confidence from Italy and France today. In the UK, the FTSE 100 dropped 0.8% to end at 6,365.27. The British economy grew at a weaker than expected pace during the third quarter, but the slowdown is unlikely to shift Bank of England officials' view that interest rates in the UK will need to rise sooner than markets expect. Britain's gross domestic product rose 0.5% between July and September, an annualized rate of 2%. This was slower than the second quarter 0.7% expansion and undershot expectations by most economists and policymakers, including the Bank of England, who were expecting growth to come in at 0.6% quarterly rate. Slower growth in Britain could be a sign that weaker global activity is already hampering the economies of Western nations, as the UK is the first country among a group of 7 countries to release GDP numbers. Tepid Chinese data has spooked investors across the globe who fear a slowdown in emerging markets could further clog trade channels and pose a threat to developed nations. According to the UK Office for National Statistics preliminary figures, however, the British economy slowed due to a strong dip in construction output, as well as earlier than usual summer shutdowns in car factories and oil extraction firms in the North Sea. This lifts hopes that growth will be increased in following estimates, as officials expect September's industrial production data, which aren't available for the preliminary take on GDP, will show a strong rebound from this summer's low. Construction figures, which have looked bleak for months, are also prone to upward revisions. The pound traded down about 0.3% at 1.5311 in the wake of the GDP report yesterday. In the Asian and Pacific markets, we had Japanese large retailers' sales for September 0.1% less than previous, now at 1.7%, and Japanese retail trade year-on-year 0.2% worse than forecast, 0.6% worse than previous, it's now at negative 0.2%, and the retail trade month-on-month was 0.7% better than expected at 0.7%. Asian stocks followed U.S. shares lower as material companies led declines and investors awaited a Fed decision on monetary policy. The Nikkei 225 is 122 points down yesterday. It's 75 up today. Overnight, the Japanese industrial production year-on-year and month-on-month, and Japanese foreign bond investment and foreign investment in Japanese stocks. This will be overnight today. In Australia, we had CPI data quarter-on-quarter come out 0.1% worse than expected. Year-on-year, 0.2% worse than expected. Australian dollar trimmed mean CPI quarter-on-quarter 0.2% worse than expected, and the year-on-year is 0.3% worse than expected at 2.1%. Australia's dollar tumbled after data showed third quarter inflation unexpectedly slowed and moved to the lower end of the central bank's target band. Fueling speculation, policymakers will reduce the benchmark rate as soon as next week. Today, New Zealand interest rate decision and monetary policy statement. Again, this will be in the nighttime, European time. Commodities, crude futures fell sharply to slump to near 2-month lows on Tuesday as investors awaited the release of the American Petroleum Institute's weekly crude stockpile report. The API late Tuesday said crude stocks last week jumped 4.1 million barrels, well above the 3 million barrel gain seen, and 1 week after reporting a surprising build of 7.1 million barrels. U.S. natural gas prices tumbled to their lowest level in 3.5 years on Tuesday, as expectations of an unusually warm winter heaped more pain on energy producers already reeling from the collapse in oil prices. The amount of gas in storage is approaching record levels for the first time in years, according to the U.S. Energy Information Administration. Gold had a range of $8, trading at $1,171 now. Silver had a range of 17 cents at $15.95 now. Crude had a $1.20 range at $43.23 now. And natural gas is trading at $2.35 at the moment with a huge range of 42 cents. Thank you, everybody. This was today's European Session Outlook. My name is Alex, and I'll see you next time. Goodbye.